Hello, everybody. Welcome to Korean Atlanta Mentorship. And I'm going to just kind of tell you a quick background story about myself. So, back in 2017, people were like advertising, like, oh, learn about velocity banking. You can pay off your mortgage in 5 to 7 years. And at that time, I was so broke. I was like, I'm not really interested in that because I'm so afraid of like, I'm afraid of the idea that I would apply for a mortgage, I get denied because they'd like laugh at me because I'm so broke. And so I never really want to learn it, but at the same time, I was a little bit curious to figure out like what is this big deal about paying off your mortgage quickly, right? Because I had no idea how mortgages work, and to be honest, there's a lot of people where I just do a basic explanation of I just ask them, hey, like, has anyone ever like gone over with you how a mortgage works? And then I just show them like, hey, just do some calculations, and then their mind is blown. And that same thing happened to me too. So basically, what happened is I took the velocity banking class, even though I didn't feel like it was worth it to me at the time, just because I felt like I'm never going to own a home. So what's the point? And one of the most profound things that I learned about the class and why the debt needs to be paid off quickly, or mortgage needs to be paid off quickly, is because if you let it go to the 30-year term, based on the interest rate, it's going to be an insane amount of interest that you would pay. So even at a 3% rate for 30 years, which people consider to be like, oh, that's a really good rate, you'd be paying 50% total interest at the end of 30 years. And then for 6%, it's a little bit over 100. And then at 9.4%, that's about 200% interest. And that blew my mind. I was like, why would anyone want to be a landlord if you could just be a bank, right? Like you'd get 200% on your money. I don't think most landlords even make anywhere close to that, right? And so once I learned that, I was just so blown away. I was like, am I the only one who's like fascinated by this? And one of the ways that I've gotten people to be interested in learning about real estate, even though they've never really done a deal or never even owned a home, is just I just kind of review like, hey, has anybody ever gone over how a mortgage works with you, right? And then I just kind of show them the following, right? But I'm not going to go over the exact calculations about how I do this, but what I want to show you is that you can just easily verify with it for yourself if you have Google, or you could just use this free mortgage calculator that you could get at mortgagecalculator.org. Now you may say, hey, I don't even have a copy of Excel, right? You can get a free web version at live.com or office365.com or office.com, I think. You get a free version and just use that. So just download this Excel calculator or mortgage calculator, Excel version, upload it to the Microsoft 365 Office platform, and then just go from there. But let me just show you something. So here's a loan amount, here's the interest rate, here's the loan year in term. So we're just assuming a 30-year mortgage, and I just put 3%, right? $100,000, 3%. And let's just, optional payment should be zero. Extra payment should be zero. Look how much interest you're paying. So $51,000 out of $100,000, that's a 51% return for the bank, right? The bank is making bank, even at 3%. So, and it's not dependent on the loan amount, it's dependent on the interest rate and the term of the loan. And the longer the term, the lower the payment. So if you think that banks love high payments, they actually don't want that because they don't make as much interest on the loan if they have, let's say, a shorter term and higher payment. Now, if you have a higher interest rate, that payment amount goes up too, but they kind of trick you in a way to thinking like, hey, that low payment is pretty good, even at 3%, so 50%, 50%. So now one of the things I want you to do, this kind of be like your own homework if you want to think of it that way, is just play around with this, right? And so I played around with this, and I know in the top of my head three numbers: 3%, which is about 50%, 5.4%, which is about 100%, and then 9.4%, which is about 200%, right? And there's no real way to figure out other than just like kind of doing, playing around. But let me just show you one other thing too. So if I add an extra zero, all that happens is that an extra number gets added here, but it's still 51.7%. So it's not proportional to the loan amount, or it's always the same proportion to the loan amount, so always 51%, but it's not based, it doesn't change based on the loan amount, right? So 3%, 1 million, get $517,000 of interest. And think about this. Let's say you bought a property in like a crazy market like New York and San Francisco. I don't know why anyone would buy property there, but people do. Or New York City, I mean. And so, you see those like tiny shack houses that go for like $1 million. Well, if they get like if current interest rates are like 7% on a $1 million property, let's say in San Francisco, they're actually paying 2.34 million, right? Around 2.4. So you pay $1 million for the house and then $1.3 million in interest in the 30-year loan, assuming you actually make it to 30 years. Now if we actually really go deep down into it, because people refinance and resell their home or sell their homes, that 30-year loan just gets restarted over and over again, and they pay more and more interest, assuming that they have the same interest rate and they're buying a property at the same price level. But let me just go here, and I'm just going to go to the topic of the video. If I do 5.4%, look at how much interest I pay. So it's about the same. So $1 million here and about $1 million in interest. So you're paying like 200% of the purchase price in total. So think about this, like how many homes are you paying for when you get that 5.4% interest rate? You're actually paying for two homes. You're paying for your own home, and then you're paying one home to the bank, right? So if you're gonna go get a 5.4% mortgage in a place like San Francisco, where that's a $1 million property, instead of giving, if you want to be charitable, instead of giving that $1 million of interest to the bank, just give it to me. You know what I'm saying? I could kind of use it. No, I'm just kidding. But so my point is that even at, people think, oh, because interest rates are like 6, 7s, well, definitely 7, 8, boarding around that. So if you're putting like 7%, 1.3, 8%, 1.6, and let me put 9.4. This is like subprime. You can kind of see that 9.4, you pay twice the amount in interest at 30-year loan. So how many houses are you paying for then? You're paying for 3 houses. You're paying for 1 for your own house and 2 to the bank. And this is another commentary about how people get broker at higher levels. So let's say you work in like San Francisco, one of those tech companies, and get a $300,000 salary, and you live in the city of San Francisco, and you needed to buy a home there. Well, if you buy it at the current interest rate, let's say 7%, then that $1 million property becomes a $2 million property, and that $300,000 salary does. I guess you could afford it, but it doesn't really mean that much. You know what I'm saying? So back to the topic of the video. Yes, banks do make almost a little bit more than 100% return at the end of 30 years on a 5.4%, and that's assuming you never refinance. And the vast majority of Americans always like to refinance, right? So think about that. But it goes back to the questions like, why would I ever be a landlord if I could just be a bank, right? If because landlords have responsibilities, but if you're a bank, you give the responsibility to the owner. And so if something goes wrong, if you're a landlord and something goes wrong, like a tenant destroy something, or maybe the air conditioner breaks, you as a landlord have to be responsible fixing it and spend some money. But if you're a bank and you have a mortgage on a property, and if something breaks in that house, that bank never like checks in or anything like that. They just want to collect their payments over time. So this is kind of like the best industry to be in if you want to do absolutely nothing and make money out of thin air, essentially. Well, it feels like it. All right. So hopefully this helps you understand how mortgages work, and or how mortgages work. And if you have any other questions or comments about what we cover here, please leave them in the comment box below. Also, if you're interested in joining our group for mentorship, please click the Google form link below, submit it, and we'll give you a contact. Or you could also email us by going to the About page of the YouTube channel. So have a great day, everybody, and we will speak next time.